Siddharth Bhamre of Angel joins us right now to speak about his sense of how the futures and options expiry is shaping up. Siddharth, good to have you. Thanks so much for joining in. 44-45% market-wide. How do you think the series is shaping up, and how do you think the climax will be?
Good morning. What I feel, Neeraj, is probably this 5150, 5200 may hold on for this expiry, but may not for May. What is bothering me at this point of time from FNO data is the index futures, and especially Nifty open interest. If I compare with Tuesday of this expiry to last Tuesday, I mean to say of the penultimate week of last expiry, there is 32% decline in open interest in Nifty futures. If you look at the FII's cumulative position as a percentage of total gross market position, has come down to 30%. Usually it is somewhere around 36 to 37% is considered as normal position. So FII's interest is coming down. Index futures open interest is coming down. And whenever we have seen in past, if you take the recent example, that is on 30th of December 2010 and 28th of July 2011, those were expiry days. And when open interest has significantly come down, we have seen almost double-digit correction in market. At the same time, the other rationale or why we are slightly bearish on the market, if I see interest rates, the bond yields, 10-year bond yields, and compare it with Nifty or Sensex movement. Interestingly, there is a direct correlation. If interest rates, that is bond yield goes up, equity market goes up. If bond yields come down, equity markets come down. And there is a lag effect. Equity markets are followed by your bond yields. So that is also not giving me a very positive picture from a medium-term perspective. And at the same time, I mentioned about the FII statistics where, these guys, and yesterday's cash-based figure of 800 crores is quite a big figure after quite some time. So liquidity parameters, FNO parameters are suggesting that, probably for these 2 days, that is today and tomorrow, you might see 5150, 5200 holding on. But again, come May, I think first half of May would be painful, and we would see probably levels of 5050. We are expecting probably a sub 5000 levels, but as of now we are just having a target of mine 5050. What one should do is a sell on rise. It is possible you might see 5250, 5300. If you see those levels, create short positions. If you don't want to take risk, implied volatility is still very low, Neeraj. 19.5, 20% implied volatility for a put. And if you're expecting markets to go down, then implied volatility for puts can shoot up to 28, 29 levels. And at the same time, this is one of the largest expiry which is coming. 31st May is the expiry date. So you have almost 34 days, calendar days. So IVs are less, view is bearish, and it's a long expiry. Buying a put option is an ideal strategy.
So Siddharth, which sector do you think is going to lead to the downfall, or is it going to be across the board weakness that we are going to see in May?
Aisha, we may see across the board, but there would be few pockets where there would be large impact, and banking, which is liked by all, I think would suffer, the most, and we have statistical reasons for that. Again, the thing which I mentioned about the bond yields, and if you do it with Bank Nifty, again there is a direct strong correlation. Second thing, where Nifty is reducing open interest day by day with fall in price, if you compare today's data with the last month's data, Bank Nifty has added somewhere around 19-20%, and most of the built up has happened somewhere around 10,400 to 10,600 from where Bank Nifty has corrected, and most of these positions are short positions. At the same time, if I see SBI, I think it would again revisit its 2100 support, and this time it would breach it. ICICI Bank has gone below its strong support of 840. Axis Bank is looking weak. I don't think so any major PSU banks are looking that strong. So Bank Nifty would be one space where I would continue to hold on my short positions.
Until expiry, probably difficult to shape it up post expiry, but until expiry, how do you play IT after the up move that we saw yesterday?
Neeraj, Infosys would remain a sell on rise because we have seen a lot of short positions which got formed, and there is no trace of covering of that short positions. Yesterday, buying TCS after a gap of opening, whatever the gap was, 3%, 4%, was very easy trade. Why so? Because after Infosys result, there was huge formation of short position in TCS also, and those short coverings were expected. Now yesterday, if you see, there is a hardly 2% decline in open interest. So people would anticipate that there is further short covering which is coming. But what we have observed that there was short covering plus formation of long positions. So I would agree with what Ashwini is saying, that if you get a dip probably in TCS, that's a good stock to get into. Wipro, short covering bounce in entire series, if you see from 415, 420 to current levels. Yesterday we saw a huge formation of positions. I think it's blend of both, around 10% rise in open interest. Results have been in line. It has not been great. I anticipate that in this expiry, it is difficult for Wipro to even give 5-10 rupees upside move from current levels. So if you're long, book profit and move out. Shorting is not which we are suggesting in Wipro.
Right, so that you were talking about as to how banks are going to be the most hard hit. What are the other pockets wherein you may see weakness? Is cement also a short?
Actually, I was surprised in month of March that why cement counters were going up, and I'm not surprised in month of April because they are coming down. Honestly, both the months we have not initiated any trades because there are a lot of other heavyweights and other stocks which would give you a better idea, because the open interest over there is quite reflecting the trend which they are into. Well, I'm seeing cement space broadly, and I'm seeing that there's a good amount of shorting which is happening. But at the same time, there are few stocks which have come down to their support levels. I'm not suggesting to go ahead and buy. If you get a bounce, I'm not tracking the levels very closely, but looking at the trend, if you get the bounce of say 2-3%, which is likely if you had a one good day in market, then I think these are sell-on rise candidates rather than buying. At the same time, the other heavyweights like L&T, BHEL may continue to see the selling pressure. Other heavyweights, I think IT would be a bit resilient, including Infosys. It may not fall significantly, but still is a shorting candidate for smaller gains in downside. Bharti has broken its very strong support of 315, 320 odd levels. So that is where, I am a bit doubtful whether this stock would bounce back or probably go down to 250, 260. So that is also one stock where you would see good amount of shorting taking place. Reliance may come down to 700 levels, 60, 80, 700. That would also one of the stock which would contribute to a lot of fall. But then again, that buyback is on. So don't think so that you would see levels significantly below 700. So if you see 700 in Reliance, it's a good covered call writing candidate like NTPC or ONGC.